Chevron, and their shares are rising after the oil giant posted fourth quarter results, raised its dividend. Wasn't that long ago. I read a piece and called Mike Wirth and said, hey, listen, here's a guy, an analyst, who says you're going to have to cut your dividend. That doesn't seem right. Michael Wirth, Chevron CEO, joins us first on CNBC. Hey, Mike, you're making a lot more money than a lot of people on Wall Street thought. How's that possible?
Jim, it's good to see you. 2023 was really a year of records for us. We had record global oil and gas production, over 3.1 million barrels a day. We had record production here in the U.S. In the fourth quarter, we had record production in the Permian of over 860,000 barrels a day, on our way to 1 million barrels a day in 2025. And we returned more than $26 billion to shareholders through our dividend and our buyback. Almost 10% of our market capitalization was returned to shareholders last year. And as you said earlier this week, we raised our dividend per share 8%, which is the 37th consecutive year that our annual dividend payout has increased.
So you still want to do a giant deal, even though I felt that after reading this quarter that Chevron's great on its own. Why is it? What's necessary? Why do a deal?
Well, we have a great portfolio on our own.
I know.
We can continue to create value and deliver performance. But this is a resource acquisition business. It's a depletion business as we produce our resources, and we're always looking to strengthen our portfolio. This is a long-term play with a company that has a very strong set of complementary assets to ours, and it underpins our growth in free cash flow, not only through the balance of this decade, but well into the next, which is important when you've got a track record of organic investment and shareholder distributions, as I just mentioned.
Well, the reason I bring it up is because the FTC has decided to probe the Occidental Crown Rock merger, and I thought that was a little thing companies are doing and shouldn't even hit the radar screen of the FTC. And then you got your deal with Hess. Are you prepared to fight if they don't like this deal? Are you prepared to fight for it?
We don't think there's any real substantive anti-competitive dimensions on our deal. We do have a second request. We've been working with the FTC. It's a very broad request, and so we're producing documents and working with them to be sure that we're delivering what they're looking for. So that does take some time. We still anticipate closing around the middle of the year, and we'll work with the FTC to get through the process for a deal that really poses no issues.
Mike, you're a person who really knows more than just the nuts and bolts of oil. Can you speak to what's happening in the Red Sea, and also what would have happened in another era, say 1973, when there was a war in the Middle East, and what was done to our country because our country resupplied the country of Israel?
The situation in the Middle East is volatile and risky right now. Certainly, we've seen an impact on shipping, container shipping, as well as in our industry. Interestingly, prices have not really reflected the risk that you might have seen in times past. Part of that is because while the Middle East remains a very important source of supply for the world, there are other places that are important sources of supply, including the United States of America, which is now the largest producer of oil in the world, larger than Saudi Arabia or Russia. Last year, over 13 million barrels a day, and will likely grow again this year. And markets now have more diverse sources of supply. The U.S. has more diverse sources of supply. And so we see the importance of reliability in energy. And that, I think, is one of the reasons why markets have been a little calmer than you might have expected given these events.